Now let's focus on the edges of the value area, the value area high and value area low. These are two of the most important levels you'll ever trade, so pay close attention. The value area high, or VAH, is the upper boundary of where 70% of trading volume occurred. When price approaches the VAH, we consider it to be trading at a premium. Here's why this matters. If buyers and sellers were comfortable transacting within the value area, then prices above that range are relatively expensive. What typically happens at the VAH? We often see bearish reactions. Sellers step in because they view these higher prices as overvalued compared to where the bulk of trading occurred. However, and this is crucial, if the VAH is broken decisively, it often flips to become support. Broken resistance becomes support. The value area low, or VAL, works in the opposite way. This is the lower boundary of the value area, and when price trades down to the VAL, we consider it at a discount. If the majority of trading occurred above this level, then prices at the VAL represent good value. What do we typically see at the VAL? Bullish reactions. Buyers step in because they see these lower prices as cheap compared to where most of the volume transacted. Just like the VAH, if the VAL is broken, it often becomes resistance on any retest. Here's the key insight. These aren't just arbitrary support and resistance lines. They're levels where the market has proven it will react based on actual trading activity. The VAH and VAL give you precise, objective levels to base your trading decisions on.
The point of control, or POC, is arguably the most important single level in your entire volume profile analysis. Let me explain why this level is so crucial and how to trade it effectively. The POC is the price level where the absolute highest volume occurred during your selected time period. This is where buyers and sellers were most active, where the most intense battle between supply and demand took place. Here's what makes the POC so special. It represents true fair value. When massive volume occurs at a specific price level, it means both buyers and sellers were happy to transact there. Buyers felt it was a good price to buy. Sellers felt it was a good price to sell. This creates what we call fair value. Because the POC represents fair value, it acts like a magnet for future price action. Markets have a tendency to return to areas where significant trading occurred, and the POC had the most significant trading. Now, here's how to trade the POC. It can act as both support and resistance depending on how price approaches it. If price comes down to the POC from above, it often finds support because buyers remember this as a good buying level. If price comes up to the POC from below, it might find resistance because sellers remember this as a good selling level. You'll often see consolidations around the POC because this is where the market is most comfortable. Both sides are willing to trade here, which can create ranging conditions. The POC is also an excellent take-profit target because it represents where the market naturally wants to return to. When you're in a winning trade, the POC gives you a logical, data-driven exit point.
Let's talk about high-volume nodes, or HVNs. These are additional volume spikes that appear on your volume profile, and while they're not as significant as the point of control, they're still incredibly valuable for your trading. High-volume nodes are areas of high volume that aren't the point of control. They usually appear as visible spikes in your volume profile. Your eyes will immediately see them without having to search. They can appear within the value area, but more often I use the ones that appear outside the value area. Here's what HVNs represent. These are secondary areas where significant trading activity occurred. Maybe there was a battle between buyers and sellers. Maybe institutional players accumulated or distributed positions, or maybe the market found temporary equilibrium before moving on. Now, here's my honest take on trading HVNs. I personally don't like taking trade entries from these levels. I haven't found much success shorting from resistance HVNs or buying from support HVNs. However, and this is important, you might find success with them. Every trader is different. Where HVNs really shine is as take profit levels. They make excellent targets because they represent areas where the market has shown it will react. When you're in a winning trade, HVNs give you logical places to take profits based on actual market structure. The key with HVNs is recognizing them quickly. They're visually obvious on your profile. Don't overthink them. Don't search for them. If you see a clear volume spike, that's an HVN worth noting for your take profit planning.
Now let's discuss low volume nodes, or LVNs. These are the complete opposite of high volume nodes, but they're equally important for your volume profile trading strategy. Low volume nodes are areas on your volume profile where little to no trading volume occurred. These are price levels where neither buyers nor sellers showed much interest. You'll see them as gaps or very thin areas in your volume profile. Here's something interesting. LVNs often align perfectly with what IC key traders call fair value gaps. This isn't a coincidence. Areas where volume was light often correspond to areas where price moved quickly without much transaction activity. Why do LVNs matter? Because markets are naturally drawn to areas where little trading occurred. Think about it logically. If very few transactions happened at certain price levels, there are likely unfilled orders or unfinished business at those levels. Price tends to move quickly through LVN areas because there's little interest to slow it down. These become thin air zones where price can accelerate rapidly. Like HVNs, I personally don't prefer taking trade entries from LVN levels. However, they make excellent take profit targets. When you're managing a winning trade, LVNs give you logical areas to take profits before price potentially reverses. The key insight with LVNs is that they represent areas of market inefficiency. The market didn't spend much time or volume at these levels initially, so it's likely to revisit them to establish more complete price discovery. Remember, you're looking for thin or empty areas in your volume profile. These stand out just as clearly as the high volume areas.
Thanks so much for watching today's video. I really appreciate you taking the time to tune in. If you enjoyed it, make sure to follow me across all platforms so you don't miss future content. Down in the description, you'll find links to the brokers I personally use, some backtesting software I recommend, and of course, our free Discord community where you can connect and learn alongside other traders. I'll leave you with one of my favorite verses. Ephesians 6:10. Finally, be strong in the Lord and in the power of His might. And as always, remember, strive for progress, not perfection. I'll see you all in the next one.